I'll start with a quick question to you guys. Let's gauge your level of experience and interest in the Ethereum ecosystem. The question I have is what kind of applications that you know that are currently in production on Ethereum that are useful and that you can actually see that there is usage and it's in production. Anyone? Well, go ahead.
ERC20.
All right, great. That's a good one. Any particular applications of ERC20, maybe?
Well, it is an application.
It is. It is. This is true. By far, probably the biggest user in volume. But there are a few products that are available on the Ethereum mainnet. One of them is Ether Delta that generates about 20, I think, % of the daily usage of Ethereum. And I'm happy to share with you our experience bringing an application to production on the Ethereum network. And just to introduce you into the importance of insurance, in real economies, single-digit percentage, sometimes it reaches 6-8% of GDP. It's the portion of GDP that goes towards insurance premium incomes. And if we're all together as a community building token economies, then it's obviously that there has to be a risk transfer mechanism to protect the participants of these economies from various unfortunate events that sometimes may happen, such as wallet insurance breaches, such as loss of collateral if someone is collateralized, uses the collateral to obtain, let's say, a loan. So these are the type of products that are native to the crypto community that we're receiving requests and interest from third-party developers to build the products. But why are we doing it? We see three problems with the traditional insurance market. One is a conflict of interest that derives from the information asymmetry between various participants. The second problem is the cost structure. Because of the insurance companies have quite high costs about bringing the new products to market, we simply don't see products that are where premiums are in single dollars or where the market might be for a certain product might be $50, $150 million. These are too small of a markets for insurers to actually go after and build a product. So as a result, we only see limited selection of products available to help the consumers transfer the risk. And finally, we see that because of how insurance is regulated, essentially it's a government sanctioned monopoly, where select few have the right to experiment and bring new products to market. So we're building a decentralized insurance protocol which will facilitate and incentivize and punish various market participants, how they come together to build new risk transfer vehicles. And we're starting with building a platform for insurtech startups to help them bring new products to market faster. And I will show you, this is our team. We have some amazing team members and advisors. Thanks to everyone from our team to help us and to bring us where we are. And this is our product that is live on Ethereum mainnet. We were extremely happy to have a chance to launch a real insurance product, fully licensed. It's licensed out of Malta and available to consumers worldwide. We launched this fully licensed product for DEF CON, the Ethereum Developer Conference in November in Cancun. And the smart contract, backed by a real insurance company in Malta, sold 76 policies. accepted premiums in Ether that went into the risk pool on Ethereum mainnet, and fiat currencies were accepted through a centralized entity that obtained a payment gateway merchant bank through Stripe. And I will show you how it works. The application is very simple. You select where you're flying from, where you're going to. And when you apply for a policy, you select the flight, and ultimately, when you submit you want to submit a payment. Before that, the pricing happens of your risk, and each applicant has a different price, right? Because some flights are always on time, almost always. Some flights are notoriously bad. So by obtaining the historical price for each flight, the smart contract prices the policy individually and presents with the payment options. The payment is based on the amount of delay, and if such delay happens, then the payout goes automatically to the consumer with data supplied by FlightStats API, which is an Oracle. For now, it's a single Oracle. We plan to add multiple so that we de-risk the data provider failures. When users pay in Ether, they launch a MetaMask and submit the premium. The premium goes to the smart contract, and this is how the transaction looks like. When it accepts the premium in, and this is how a number of applications, how you can see that smart contract is getting the premium. Essentially, it's a flow of funds. It is premium income in accounting terms for an insurance company. At the end, to give you an idea how we monitor performance, we just query the smart contract on mainnet, and we run the reports just like this, where we can see that the flights were pretty much better than expected, and smart contract made an underwriting income of about 3 Ether. For the flights that were insured in Cancun. So from a regulator perspective and an insurance company perspective that backed that provides the compliance, it's a great experiment. Smart contract makes money, and there is underwriting income. All the reports that they are looking for compiled from these numbers. As a result, consumer is, after payment with Ether or fiat currency, dollar, pounds, or euro, is presented with the proof of a successful application that is processed. They can take a look at their transaction on Ethereum mainnet through Etherscan, and they can click and receive the certificate of insurance that has the policyholder's name, the policy number, and details of the coverage. A copy of the policy certificate of insurance sent by email. This is due to requirement of regulators in the European Union, in Malta in particular, for the policyholder to have a copy of the certificate in a durable form. And the PDF sent by email is a durable form of a certificate, and therefore we have another check to comply with the requirements. And that's how the user experience and customer journey of someone who is buying insurance from a smart contract. This is how it works. It could be made very simple and could be embedded into various destinations where consumers travel. So with a small little third-party JavaScript piece of code, anybody who is operating a marketplace of tours can embed a flight delay policy into their product. Or even travel management companies can put the product in front of their travel agents, making bookings for business travelers who may be interested in a higher limit travel flight delay insurance when they fly an attorney or highly paid consultant and they get stuck for 10 hours while earning $700 an hour. You know, it's a loss of revenue or profits, and that could be protected with this product as well. Said that, this is a template that we're giving to the community to build on top of Etherisc. Products that of various types. We have received a number of requests and a number of teams started building the products using our templates and the models that we are open sourcing. Requests range from auto insurance, one in European Union, one in Eastern Europe, to crop insurance in India, insurance for horses that do sports jumping. We see all kinds of insurance products that are interested in accelerating their time to market. And for some of these products, parametric model that is available out of the box and fly delay works just perfectly. Replace the pricing and the API that provides the claims data. For those products that require claim adjustment, the third-party administrator essentially is an oracle, and they submit the numbers, what to pay to the consumer. So products like crop insurance parametric are very easy to build now, and given that we will help these insurtech companies obtain the license, we hope that we will reach a guarantee of 180 days that we will promise to anybody with a risk model, a data set, to go to market and start selling a licensed insurance. And all of that is facilitated by the token model that revolves around two types of tokens. The one token is the risk pool token. This is clearly a security token, and it's up to the builder of insurance product whether they choose to securitize their risk pool or use traditional reinsurance. If they choose to securitize, they might be interested in joining Smart Valor team, for example, and taking their securitized risk as an asset class to a broader base of investors and constituents that might be interested in obtaining an asset class that does not correlate its returns and risk profile. It does not correlate with the stock market or debt market or crypto market, and I will explain how it works. But the platform token is the one that does not carry any risk. It's not does not represent securitized catastrophe bond, for example, or flight delay risk. Is just a vehicle for various participants in the platform to work together, and it's an incentive mechanism and a punishment mechanism. So whenever someone is promising to deliver data on time, fast enough, we have two choices how to structure this relationship. One choice, we can have a paper contract and where they guarantee certain performance, right? And then if something happens, we have to sue them, take to court, and that has a big cost, right? And if we're talking about small insurance products, niche, it's cost prohibitive. That's what brings the cost of development up. We have a second choice of using the platform token to be the staking mechanism, where if the performance of the data provider, for example, is not very good, less than promised, then they lose a portion of the stake, and that's the whole resolution, right? No need to go to court. Essentially, this we arrive to a revenue model for various participants who might be interested in using the Etherisc platform and the protocol to build, launch, and operate insurance products and tokenized risk pools, or also called insurance-linked securities. To make a living, to sell their license if they would like to participate and do the fronting, to sell reinsurance. These are all use cases where various participants can come together and work around a single goal where they are way more decentralized and earn a bigger share of the result, which is the underwriting income, investment income, or the reinsurance income. And this is the three types of revenue sources that might exist for various participants. A service provider, or let's say a data scientist with the risk model, can have a quite big share of underwriting income and make money by predicting whether in certain location or certain house whether it will get flooded, and with what percentage of likelihood, right? This becoming possible for a single individual to have a portion of premium income, of revenue, or underwriting profits or reinsurance profits that derived from creating a new insurance product. Today, it's impossible for any individual to make a fair share of the outcomes that they produce. They have to either get employed, or do consulting, or start their own insurance company with all the different hassles which we hope to remove in certain markets, especially in those where we are located, which is European Union. Where we will provide the licenses to anybody who wants to operate an insurance company, and the United States. That's how the two different types of tokens in the risk transfer industry work. And we're currently building and hardening the requirements for the protocol so that the incentives and punishment mechanisms that are fine-tuned, and we're building it as we bring our own templates to market. We continuously learn how the different participants in the market want to work with the underlying infrastructure, and we believe that a generic protocol and generic templates that can be applied across different product lines, across different type of risks, across different type of assets, is the one that will receive adoption among the developers of insurance products. And we currently reviewing the role of the oracles in the flight delay, for example, and we're not extremely happy with the performance of not just the oracle services that sometimes don't return callbacks in a timely basis. So we see how the staking mechanism can be used to punish such poor performance and give the funds to, let's say, a human resolver who will go and find whether this flight was delayed or not, and use these funds taken from the stake of the oracle provider and give it to, let's say, someone on Mechanical Turk who may manually go in and find whether this particular flight was delayed or not, because sometimes we don't receive callbacks. And this is an example of how the role of the token resolves this very problem and incentivizes the new participants in the ecosystem, allowing them to earn fees by working on the platform, and it punishes those who don't perform for whatever reason. Maybe it's just too little of a price for them and they don't care much, right? They might be doing fine. So these are the various mechanisms how the token is being used in the ecosystem, and ultimately we believe that the economic model of traditional insurance companies and how they're building the products, how they're bringing them to market, how they treat the risk once they acquired them, and their insurance company is not very happy with the securitization of risk that is just taking the risk away from them. And in this very city, New York City, MTA, the Metropolitan Transportation Authority, I think that's what abbreviation stands for, successfully securitized the risk of flood and did it without the insurance company. They just circumvented the whole risk transfer process and issued a bond that pays interest. And if there is a flood with the hardware devices installed in multiple locations of New York City, if they get a reading of water, then investors who get interest every month, they will lose a portion of their principal, right? And there was no insurance company involved. There were just some professionals to structure this deal, to build a risk model, and essentially this is an example how the traditional risk transfer industry is being disrupted, not just by new ways of transferring risks and removing middlemen out of the picture, like what we are trying to all enable, but also in a traditional legacy world, there are ways to remove the middleman too, and we're not inventing securitization of risk. It's a big booming industry, and we believe that the shared capital and infrastructure that is enabled by programmable money and programmable assets is the way to protect the decentralized economies, the token economies that we're all dreaming of and we're all building. So we hope to see that at some point, single digit, maybe 3%, 5% of token economies will be protecting the consumers and participants of the decentralized economies and making their life simpler, more secure, and people will get paid if their multi-signature wallet is hacked, or if their payment channel on Rootstock is not performing well, or if the collateral that you use to obtain a loan by locking your Ether or Bitcoin quickly lost its value, right? All of these are examples of crypto-native use cases that we received. Requests for building insurance templates for, and we're looking forward that the economic models that incentivize different participants will protect decentralized token economies in the future and make the world a better place. Thank you very much.